I guess a little bit more fuel onto that hawkish fire that probably has been the key cause for markets pulling back this week.
Yeah, I think that's probably right. You saw that in November, and you saw risk-off trade followed by a reversal. I think people are overreacting to what they perceive as hawkish, and I continue to believe the Fed will not be able to raise the front end. Maybe not at all, maybe once. I just don't see how they can argue they have full employment and stable pricing in this environment. So I don't believe that people's perception will remain there for very long.
So in terms of the correction that we've started to see, I mean, most pronounced, of course, in those unprofitable small mid-cap tech stocks, but starting to infect a couple of other areas, while energy and banks have started the year well. That sort of sector rotation, does that continue, or already are we talking about buying opportunities in some of those areas that are pulled back?
Yeah, I've been spending a lot of time on the road with investors this week, and I think people are trying to figure out what sold off in Q4 that's an opportunity, what sold off that I can still press the short, and then kind of rotating in this year the same thing. I have to break those up. Last year we were bullish on equities, bullish on energy. Energy's up 50, so it's up 9 this year, and it's not like it's different than last year. It's still risk reward on oil is skewed to the positive, and the stocks are cheap. I think banks are different. This is a pure reaction to interest rates and the 10-year backing up. I continue to think that banks are going to be challenged on growth, and that there's excess capacity in that industry. So I like the big banks more than the small ones, simply because they have other business lines, shareholder return, et cetera. So I could see selling some of the banks in the short term to fade this a little bit, whereas energy, to me, the risk reward is still very skewed to the positive.
But if you don't think, Adam, that the Fed is really going to go through with the number of interest rate hikes and balance sheets shrinking this year, which is a reasonable assumption, then wouldn't you be buying the high-growth tech names that have been hardest hit by this valuation correction?
Generally, we've had a slight underweight view on tech. I generally think that the way Santoli showed it, I only partially agree, because I think the software companies trade on something like EV to gross profit because their targets for acquisition, everything below the gross profit line probably doesn't matter. So the PE part probably isn't quite as relevant. I think if you're a company that has got pricing power, positive free cash flow in tech, it could make sense. The things that sold off, Sarah, that I think you want to get into are probably biotech. The market was up, 27% last year in the S&P. Mid-cap biotech was down 45. So if you look at the forward sales growth, it's probably the same. So I think that's a pretty harsh correction for innovation in that area. I probably like biotech more than I do, and then find the stocks that got pricing power. So you went through big tech, maybe Salesforce.com down a lot of Q4 on the Slack deal and some other stuff. They have pricing power. I use them as I'm a customer, and they can certainly raise pricing on me. So I think it really depends on positive free cash flow and pricing power, not just the profitless guys that worked in 2020.
What about some of those names, the kind of ARC universe, the hopes and dreams sector as coined by Josh Brown? Are those still ones to avoid, or are there any of those names that really have pulled back a huge amount that you've been looking to buy?
Most of them are probably shorts, in my opinion. I think it really depends. If they don't have, some tangible cash flow and a margin expansion story in the next, 12, 18 months, I think they're probably still shorts. I'd rather own, mid-cap biotech as a long and short that stuff against it in aggregate. You said, are any of them? Of course, some of them are. But I'm saying in the basket, I think that's not where you want to be. I think some of the work-from-home stocks that pulled back, DocuSign, Zoom, Peloton, I still think you want to be cautious on some of them. They don't really seem to have technology moats that are very strong. So I wouldn't be attracted to that group of stocks that sold off either.